Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for March 2nd, 2021. Please see our disclaimer for some important information. Well, as we finally make it to the third month of the new year, which seems a little bit like the 15th month of 2020, there is a lot going on in our markets. We had a little bit of a retrenching, if you will, in the equity markets because interest rates are moving higher. So we got to talk about that. Talk about some of the other issues going on in the economy. I'd say on whole, the data is actually pretty good, not great, but good. And I think there's a really good case to be made that interest rates are moving higher, which is fully what we expected. Interest rates are moving higher because the economy is expanding. And I think, that's a good thing. Now, there are risk factors on the horizon, and I might as well just get those out there in the front. And really the key risk out there, if there's any indication whatsoever of an impending tapering of this quantitative easing, i.e. this asset purchases that the Fed is doing to get more liquidity into the economy. If there's an easing of that, then that could cause an overreaction in the equity markets, just kind of like the taper tantrum, so-called taper tantrum that we saw back when then Fed Chairman Bernanke kind of whispered this notion that maybe the Fed would begin to slow its asset purchases as part of that quantitative easing program to help stimulate the economy. So that there's a lot of expectations built into the economy right now, and a lot of them are well founded. But in this case, where the Fed, the expectation is really strong that the Fed's going to continue to keep rates lower for longer. They're not terribly worried about inflation. The Fed Chairman Powell said this past week that he believes that the interest rates moving higher was, as I mentioned, a function of an improving economy, and so they're not terribly concerned with that right now. So that just kind of adds more feedstock to this thought that interest rates might continue to move a little bit higher, but at present we don't have the unexpected and unwanted burst of inflation that I think some people might be fearing. So anyway, having said that, let's kind of talk about the market from last week. Dow Jones was down about 1.8%. S&P was down about 2.4%. NASDAQ was down about 5% for the week. And on balance, cyclical stocks are doing fairly well. And we had a little bit of a brief rotation back into growth stocks versus value. We do have an accelerating economy. We've got earnings growth, which is accelerating. Again, we've got all this liquidity from both monetary and fiscal policy out there. Last week, we saw consumer discretionary and technology sectors fall by 4 to 5%, and then we saw utilities also fall. But energy is a really bright spot here lately. Energy crude prices that were down almost 21% last year are up about 27% this year. Currently, a WTI crude is trading about $61.50 a barrel. So, not all boats are moving in the same direction right now, but I can tell you that that there is some interesting dynamics going on in the equity sector. We continue to see, on balance, with the exception of last week, a little bit of a rotation into these cyclical stocks, into value versus growth, even though that wasn't the case last week. But it's kind of symptomatic of what we see in an emerging economy that's pulling itself out of a recessionary environment. But we did have a market drop last week as we had rising bond yields. It kind of added a jolt to the market. Rising rates kind of, I think, again, point to the optimism that we have in the global economy. But they can also make for a little bit of increased volatility as, I think the investment community kind of rethinks what the valuation equation should look like. Treasuries uh, were ended the week on a pretty wild ride. So we had 10-year yields ended the week up 8 basis points to 1.41%. And at one point they were up over 1.6%, and then just not too long ago they were straddling 1% or even 1.1. So we've had a huge move in Treasury yields. In fact, year to date, the 10-year Treasury is up about 0.5%, and the 30-year Treasury yield, 10-year Treasury is now, like I said, about 1.4. 30-year Treasury is about 2.15%, and it's also up about 0.5%. And so what's interesting here is that like the 2-year Treasury, which is still at 13 basis points, 0.13%, is only up 1 basis point year to date. So what that tells you is that just literally in 2 months, we've had curve steepening of basically 0.5%, which is actually pretty dramatic. And so it's not surprising that we've seen a little bit more gyration in the equity market as a result of that. But I think the mother's milk for continued expansion is still there. And so in kind of talking about the economy and some of the reasons why we should probably feel good about maybe the sustainability of the investment markets and certainly the equity markets here, is that February's consumer confidence reading was above expectations at 91.3, and sentiment surrounding the job markets also improved as well. We had, on the heels of government stimulus, again, this is that second stimulus payment that that hit basically in January. So this data comes to us as a lag, but January personal income was up 10%. Wages and salaries were only up 0.7%. So basically, this is all stimulus money that actually boosted personal spending, which was up 2% after 2 straight months of decline. But if you look at the savings rate, because of the stimulus money that was received, it surged to like 20%. And what that really kind of tells us is that households are kind of showing a little bit of restraint, despite the fact that we've got some really solid consumer confidence that I just mentioned. On the durable goods side, we have continued strength. I'd say that the strength has not been as strong here lately as it has been in a couple of months ago, but it's still definitely positive. I don't worry about it. Durable goods orders were up 3.4% in January, due in some respect to aircraft orders, but if you exclude defense and transportation orders, durable goods orders were up 0.5%. And looking at the other markets, so if you look at the S&P and just kind of look at it year to date, it's up about 1.5%. Dow Jones is up 1%. Again, last year the S&P was up 16.3 and the Dow was up 7.3. NASDAQ, which was up almost 44% a year ago, is up about 2.4% this year, while the Russell 2000 is up 11.5%. The Russell 2000 has had a tremendous run this year. And you look at areas that showed a lot of strength last year, as the dollar declined and real yields turned negative, like emerging markets, which were up 15, almost 16% last year, and the Asia market was up about 17%. They're up about 3 to 4% this year, so they're doing okay. Volatility for the month is down, even though it picked up a little bit last week. So that's obviously giving some comfort to investors that we have all of this money on the sidelines. And if we have time, we'll kind of talk about that. On the fixed income side, Barclays aggregate index for the year is down about 2.2%. For the month, it's down about 1.5%. So with these interest rate increases, that's taken a little bit of steam off the bond market. And leveraged loans, interestingly enough, have continued to be positive, despite the fact that the broader index is negative. Leveraged loans are up about 2%. High yield is up a little bit less than 1%, but doing pretty well. we talked about crude prices, gold, um, and gold is down. Interestingly enough, gold had a tremendous year last year, up about 24, 25%. This year is down about a little bit under 9%. So gold on the per ounce basis is about 1,728 ish. It ended last week, and interestingly enough, if you look at the commodity basket, crude is kind of defying this whole commodity trend because there's a global recovery and energy demand is expected to outstrip supply over the next few months. So that's what's going on there. But when you talk about gold, you got to talk about the dollar, and the dollar has actually picked up a percentage point this year when it was down just a little bit less than 7% a year ago. And so it's interesting to see that that's had a rather meaningful negative 9% move on gold year to date. So we've talked a little bit about interest rates, kind of on the legislative front. The House of Representatives passed the $1.9 trillion coronavirus relief package on Friday. And so, that dollar amount, when it gets all said and done, will probably maybe be a little bit smaller. Again, there's a lot of gyrations in the Senate right now, a lot of horse trading particularly on the subject of a minimum wage, federal minimum wage. But we do expect that some facsimile of this to become law before the unemployment benefits expire in mid-March. And then once we get that, and then there's all sorts of arguments on valid arguments on whether 1.9 or even 1.5 trillion, for that matter, is too much, right? Because there's a lot of care and concern in this legislation about state and local governments, and actually tax receipts have been increasing at a pretty decent rate. So there's a lot of argument to be had on whether we need a lot of this right now. But I think the fact is we're going to get it because it's politically unsavvy to vote against at least some stimulus here. But after we get that stimulus done, then we've got probably some more infrastructure spending and bills of that nature, which will be coming down the pike. And so that will add some strength to the market as well. And then I also mentioned Fed Chair Jerome Powell basically, reaffirmed his commitment to low interest rates, and that's kind of helped fuel this investor sentiment and really strong expectations for a pretty strong economic recovery, and the fact that that's what's driving interest rates higher. So again, kind of a positive influence as opposed to maybe the economy being kind of overheated and kind of on its on a adverse track. On the coronavirus, the news really continues to be positive. We've got new cases, hospitalizations, and 7-day moving average on daily deaths are down significantly. I've got a lot of data in this in the charts of the week, and you can actually see the impact of vaccinations on the rate of new cases in nursing homes and elderly residences. I mean, those are dropping off a cliff. So you can see that the vaccinations are working. We've got basically 50 million. In fact, I think we've already given closer to 65 million doses, but we know that one dose, the number of people with at least one dose is 50 million. And we've got Johnson & Johnson having received its EUA, or emergency use authorization. We know we've got a third major vaccine that is literally hitting the market as we speak. And an interesting note of collaboration, you rarely see this in corporate America, is that I heard this morning that Merck, major pharmaceutical company, is actually going to be helping Johnson & Johnson manufacture the J&J vaccine. And in a competitive marketplace, that we know the pharmaceutical business is. I think this is kind of almost unprecedented that you see this type of collaboration. But very good news overall. So um, inflation risks maybe impacting sentiment a little bit. We've talked about this. As long as inflation is not outsized and there's not a negative surprise out there, we see this inflation building up in the producer channel. We've talked about it for weeks now. There are charts in our charts of the week that we've pointed to that, the input costs for producers are going higher, and at some point they're going to have to pass this along to end consumers. We know this. It's not a shock, but we've got GDP growth expectations. We've got upwards of a 5, maybe even a 6% GDP growth rate kind of built into the current year forecast. The last chart that we had in charts of the week this week was a chart from the International Monetary Fund, which has a pretty significant economic forecasting department, and they forecasted 5% growth for the U.S. this year. On the heels of an accommodative Fed and data is improving, earnings are improving, so on, so forth. We've got a few other things that we can talk about here. Talk about bonds a little bit. Really profound that, like on the 5-year yield, we've seen that go up from, 42 basis points to 0.75% in February. And if you go back when I said, we had this taper tantrum back in 2013, rates aren't nearly as high as they jumped as high as they did back then. They were up like a full percentage point in 2 months back then when Chairman Bernanke said, well, maybe we'll stop buying as many of these bonds in the open market. But we're not quite at those levels yet. Interestingly enough, I was reading in the Wall Street Journal that we had, speaking of the 5-year Treasury, it had a really weak auction. And what that's telling you is that investors are not thrilled with the yields. They don't want to buy the paper at new auction because they feel like rates are going to go up and they're going to be stuck with a loss there. So it turned out to be a pretty weak auction for that. In fact, the bid to cover ratio was the lowest in that particular tranche, that 5-year tranche, its auction history. But the other things that are going on with that 10-year Treasury inflation protected securities. These are treasuries, but they're inflation protected treasuries. And the yield there is moved up to only a negative 70 basis points there. So, big jump in yields. I think we're going to monitor that. Obviously, we don't want to see them go too high too fast, but the fact that they're moving higher is not a shock. Stronger jobless claims report. Markets are beginning to, well, they're not beginning to, but maybe a Fed tightening coming, not this year, not next year, but maybe even in 2023. And then, like I said, the Fed is kind of being quite easy on inflation. And let's see, just talking about fixed income, yield curve, moving higher. So, the issues that you have with higher rates, obviously, is that bonds begin to maybe become a little bit more attractive relative to stocks. And that also is good for savers, but it is higher, represents higher borrowing costs for companies. And, then, the value of earnings in the equity market, are not nearly as good because that discount rate is a little bit higher. But I do feel that the Fed is going to continue to stay the course on what it's doing. That's going to, give the market room to grow, I think. And Fed Chairman Powell said the economy is basically a long way from the goals that they have for employment and inflation. and see what there's several other arguments here that could be made. Um, we talked about this, the higher yields being a statement of confidence in the recovery. We still are at a high level of joblessness. So there's slack in the economy. We still have COVID. I think the Fed is very cognizant of what happened in 2013 when they shocked the market, so they're not going to make that mistake. And then, I think just, the overall labor market is going to give them a lot of room to run. So when you talk about inflation, again, it's going up and it's okay. Since 2012, personal consumption expenditures, which is the measure of inflation that the Fed cares about, has only averaged 1.3%. And we had a chart in the charts of the week talking about the composition of inflation, and we do get a lot of inflation from the housing market. We know the housing prices are really, really high, and then also asset price inflation overall, including houses, is high. Consumer spending on durable goods was up about 6.5% in 2020, while domestic production was down about 8.4%. So you've got spending rising when production is down, and so you've got more dollars chasing fewer goods. And at the same time, you've got shipping costs, which we've talked about a lot lately, have gone up. And so, there's thoughts on commodity price inputs. I'm not sure, they may be temporary. Like I said, we've got lots of capacity left to absorb in this market before we really start hitting a choke point. And you look of, we have pent up demand. I think there's arguments both ways on how much of that has already been spent. I'd say that a lot of it's been saved. So we've got a lot of pent up potential demand in the market. If the conditions are right, consumers will take those savings off the sidelines and put them in the market. So that's a few comments on that. On the stock market, actually, let's talk about that cash situation here for a second. There's a lot of checkable banking deposits, and I've got a chart in the charts of the week about this, but we've had a drop in spending on services because of some of the COVID-related lockdowns. And so we have a lot of dry powder. We've got basically 1.2 trillion of government-related inspired income, if you will, and we know we've got more on the way. So basically, consumers have been able to save not almost $2 trillion more than they would have without all this help. And so, if you look at the end of 2019 through today, household net worth has increased by over $14 trillion. And then, this pending legislation will inflate that even more. But, savings, this is from Barron's, but savings and bank accounts, are probably going to get spent. And then, versus things like housing and real estate, which are not liquid, and you can't really spend that unless you liquidate something, and those are a little bit less liquid folks. But a couple other bullet points out of the Fed's own data that was reported in this Barron's article. If you go back to 2019 through the third quarter of last year, household net worth was up $5.2 trillion. And, just over 2% of that, or excuse me, $2 trillion of that was from a surge in bank deposits. You had about a little over $1 trillion of growth out of stock price appreciation, $1 trillion from home equity appreciation, and then the rest from other assets in the family within the household. So let's see. So basically, we're sitting on, even by the most conservative estimate, you've got $1 trillion of pent-up liquidity, and maybe more liberal estimates, you've got upwards of $2 trillion of liquidity out there that's primed and ready to go. And let's see, on the equity side, there's going back and forth on, because for every measure you find that there's room to run in the economy or room to run in the equity market, there's reasons to be maybe concerned with the valuation perhaps a little bit, but 91% of fund managers surveyed by Bank of America believe the economy will strengthen this year, and that and they're at record low cash levels right now. This fund manager survey, it's the highest percentage that they've recorded since the 1990s. But we've seen huge gains, as we reported earlier, on small caps. Small cap shares are outperforming the S&P 500 overall by the widest margin in 20 years, which is really crazy. The Russell 2000 is up 11%. Over the past 6 months, it's beat the S&P 500 by 30 percentage points. That is just absolutely nuts. So, we've got lots of stimulus. We've got lots of optimism about the vaccine, which that coupled with, maybe the ability for the dollar to perform a little bit better might give some adds to the enthusiasm surrounding that. But we've also got a lot of money plowing into ETFs, exchange traded funds, and into mutual funds. And oddly enough, even though we've got this strength in the equity market, the fund flows have much, much more favored bonds lately. But I guess when you talk about the public markets, we've had a really strong market for for new issues. Certainly for these special purpose acquisition companies, or what's known as SPACs. So we've had 8,500 public companies in 1997, and we've got 4,500 as of 2017. And then we had an addition of 494 listed companies on the market last year alone, and that was the largest number that we've seen since the late 1990s. Thus far this year, 230 companies have gone public, raising about $78 billion. And this I'm actually pulling from Sandy Leeds' weekly commentary, but and that will probably break the record this year. And a lot of that activity, in fact, the majority of it is in these SPACs, these what they call blank check companies. But since the start of the year, these SPACs have raised about $130 billion. They've just raised a tremendous amount of money in an environment that has been conducive for new equity issuance. So, just looking at that as we kind of come to a conclusion today, is that, there's a lot of enthusiasm that's still built into the markets. The data has been pretty good. Interest rates are moving higher, but that's not necessarily a bad thing. It's obviously something that you have to watch on the fixed income side, because you don't want to be in long maturity or what we call long duration assets, because those have the most price exposure. So we're very, very short in our investments. And frankly, as interest rates move higher, we'd like to just ride up that curve with our short-term investments. So we're okay with that. We certainly don't want to take a lot of incremental volatility on the fixed income side of our portfolios. So that's why we're positioned the way that we are. Still feel good about the global recovery overall. Shipping data and transaction data remains fairly strong. So, and I should say trade data for that matter, it remains fairly strong considering where it was just a little over a year ago. So I don't really worry about our position here. Again, really the lone risk is that if we have some kind of a taper tantrum, if you will, and the equity market sells off precipitously, still think that there's probably room for a 5% correction in here, largely from people kind of taking interim profits. Oftentimes in in April, mostly from retail investors, but you tend to see people kind of taking money out because the tax bill is due. But this year, given the craziness that we've seen over the last 12 months, who knows what's going to happen. But overall, feel really good about where we are right now. Obviously, want to be cognizant of the tea leaves here and making sure that we don't misread those. Just being smart with making tactical moves to kind of take advantage of some of the things that we see. Really appreciate you spending time with us today. And feel free to reach out at the information on your screen if you have questions or comments. On behalf of the entire team at BKA Wealth, really appreciate you joining us today, listening to this broadcast, and wish you a safe week and a productive week and a good week. And look forward to seeing you again soon.